Hello and welcome to United Asset Strategies quarterly investment call. My name is Thomas Healy, Chief Portfolio Strategist here at United. With me today is Matt DeLorenzo, our Chief Investment Officer, and Jiorden Sanchez, one of our Senior Portfolio Managers. For today's call, we're going to review what happened in 2022 and also what we're looking for in 2023. In many ways, 2022 was really an extraordinary and unusual year with the Russian invasion of Ukraine contributing to multi-decade highs in inflation, which then elicited a very strong response from the Fed. That response and the rise in rates really put pressure and a headwind into not only equity markets, but bond markets as well. In fact, if you look over the last 100 years, there's only 4 periods where you had stocks and bonds both down. 2022 is one of those years, with the equity market down 19.4%, and the bond market down a little over 13%. So your classic 60-40 was actually down about 17%, which is the second worst over that 100-year period. So when looking at 2022, I want to get a little more granular by turning it to Matt, who can discuss with us the Fed, interest rates, and bond markets. Okay?
Sure. Thanks, Tom. So as Tom had mentioned, the Fed had to work pretty hard to combat what had become a pretty serious problem with inflation that was compounded with the Russian invasion and everything that happened with energy prices after that. So taking the whole year in total, the Fed actually raised rates 425 basis points. So that was really, Fed funds was at a lower bound of 0 entering the year and went all the way up to 4.25 at the end of the year. So in addition to that, the Fed also began shrinking its balance sheet. And both of those things had a major effect on the bond market because rising rates directly lower the prices of bonds. And it also had another impact on the economy and more recently has started showing signs of actually cooling the inflation as well.
Okay, thank you, Matt. I'd also like to get Jordan's take on what the team is seeing from 2022 on the equity side as well.
Sure. Right. So the equity market ended the year strong. Fourth quarter returns for the S&P 500 were in the 7 to 8% range. And by the way, that's pretty much what you have seen historically in midterm election years, where seasonally the strength tends to be in the fourth quarter. Unfortunately, it didn't offset a lot of the weakness in the prior 3 quarters of the year. So the S&P had a total return of approximately negative 18 to 19% for the year. And this was entirely driven by equity valuation multiples. The PE multiple an investor pays for a stock was down probably about 22% for the year, despite earnings remaining relatively resilient. And so the overall upshot here is that investors were willing to pay less per dollar of earnings at the end of the year than they were at the beginning of the year. And this really has to do with the rise of interest rates for 2 reasons. One, higher interest rates reduce the present value of future growth. And so you saw growth stocks trade down in sympathy. Their PE multiples were down about 50% for the year versus only 5% for value stocks. And then 2, higher interest rates generally result in tighter financial conditions, which has implications for the economy over time. And you saw companies whose earnings are a bit more reliant on a stronger economy, like cyclical sectors, feel a lot of that brunt as well. So their PE multiples were down probably about 25% versus just about 5% or so for defensive sectors. And so yes, it was a pretty tough year, but for the most part, we did spend a lot of the year focused on that risk. A lot of our strategies had some embedded cash cushions, some hedges in the form of gold or inverse ETFs. And then as it relates to stock selection and sector positioning, we did take a pretty defensive tilt on that as well. Last year, in down years like that, we also tend to be pretty aggressive in terms of harvesting losses. So we did that in our equity strategies as well, just to reduce the client's tax budget.
Great. All right. Thanks, guys. I mean, I would note, along with what Jordan said, I think our real focus on risk management in a difficult year, I'm glad to say that each of our equity strategies was able to outpace its respective benchmarks for the entire year on average by about 380 basis points or 3.8%, really focusing on risk management, as Jordan mentioned. Now, looking to 2023, I would first mention a couple of macro items that we're looking towards. Obviously, one is the economy. With the Fed having raised rates, the idea is to slow the economy. Our view is that the consumer is going to be key to see if we do go into recession, and if we do, how deep and long that might be. That's about 70% of GDP. As of right now, the consumer seems to be holding up pretty well. In fact, in recent weeks and months, with the inflation numbers starting to come down, we're seeing consumer confidence numbers actually starting to move up a bit. And the labor market remains on pretty solid footing. We're seeing layoffs, particularly in the tech world, but overall the labor market is still pretty solid. And if that were to falter, that's where we would be becoming more concerned. The second thing I would just mention, Jiorden mentioned the mid-year, the midterm election. Coming out of that, we now have split Congress, and we have a debt ceiling debate already starting. So we look for the next few weeks into the next few months to see how that plays out. That's something we're going to be watching very closely. But again, to get more deeper dive into what we're seeing on the bond market, I'm going to turn it back to Matt.
Sure. Yeah, so in the second half of the year, it became clear that we were getting a little bit closer and the market was fine-tuning a little bit of where the final destination or the terminal Fed funds rate would be. So we do feel at this point, it looks like it's going to be between another 25 basis points higher or maybe another 50 basis points higher. So the next part of the debate that the bond market will really have to figure out is, will it be 25 or 50? And also, how long are they going to stay there? On top of that, how long will they continue with quantitative tightening? So we are considering all these things, and that's partly resulting in our overweight to higher quality segments of the bond market. But as inflation slows down and if the economy slows, longer duration also has a better chance of outperforming as interest rates come down. So that's a big part of our portfolio at the moment, and we really started building that out in the second half of last year. Started to be rewarded in Q4, and it's looking like that way as we enter this year as well. So things are moving around a lot, but we're very open to taking profits in some of those longer duration securities if rates fall a little bit further, but really keeping our eyes open for value wherever it pops up. If the economy slows down further, credit spreads will widen out, and there could be opportunities there as well.
Great, thank you, Matt. So let's turn it to Jiorden now for his thoughts on the equity markets.
Yes, thank you. So 2022 was all about higher interest rates and the immediate impact on valuations. You can argue that 2023 would be focused on, once again, higher interest rates, but the lagged impacts on the economy and on earnings. And along those lines, we are entering earnings season right now, and 4Q earnings are seasonally important as it relates to it being the time where most companies provide initial forward year guidance. So in other words, this is the first time a lot of companies are going to be talking about 2023 earnings and providing some sort of color around macro trends, the consumer, the impacts of higher interest rates and things of that nature. Right now, consensus expectations are for about 5% earnings growth in 2023. That's actually pretty similar to what we're expected to print for the full year 2022, despite some concerns about the economy. So as we go through earnings season, which will probably take the next month or two, we'll have more insight into the direction of a lot of these earnings as it relates to the color that companies are providing. If it's in line, great. If it's better than expected, greater. It could potentially, there is risk that it could potentially come down as well. And so with that in mind, there are also some positives that we'd focus on as well. Obviously, last year was a down year, but it's very rare to have 2 consecutive down years in the equity market. Matter of fact, 87% of the time when the market's down one year, it's up the following year with an average return profile of about 17%. This year is also the year prior to an election cycle, a presidential election cycle. Those years tend to be the strongest among the other election years, generally resulting in about a 17% return as well, versus the other years which are ranging in the 8 to 11% time frame. And then lastly, another reason to be positive is just valuations are no longer extremely expensive. They're now more reasonable, and so long as earnings remain resilient, that should bode well for long-term returns as well. Our positioning for this year really balances those two items. So one, the risks we see to earnings, but two, a lot of the attractive setup we see as it relates to the calendar year valuation and things of that nature. And so we still have a lot of the risk management in place. Things like cash, cushions, hedges, and stops are still there. But incrementally, I would say that with earnings risk being on the floor this year, we're focusing incrementally on the quality of the underlying businesses Do they have balance sheets? Do they have cash flows to help them withstand a tough economy? Two, maybe a bit more focus on the defensive sectors of the economy. So those areas that rely least on the economy for earnings growth or cash flows and things of that nature. And then finally, we're being opportunistic, trying to add exposure to some of the secular growth names that are riding secular trends and less reliant on the cyclical nature of the economy, especially given that some of those have traded down meaningfully last year. And so what we're doing this year generally does balance, continued risk management. We're looking for opportunities in light of a year that, has things on either side of the coin in terms of positives and negatives.
Great. Well, thank you, guys. I mean, clearly our investment team is very busy navigating through this volatility, both on the fixed income side and on the equity side, and will continue to do so this year for your portfolios. One bit of housekeeping I'd like to leave us with is, as we know, there's an integration going on between TD Ameritrade and Schwab. As it relates to your accounts here at United Asset Strategies, that'll have no impact from a management standpoint. We have long-standing relationships with both TD Ameritrade and Schwab, and so that will be seamless. To the extent you have questions or you get something that you're not unsure of, feel free to call your relationship manager, and they'll be glad to talk you through that. So with that, I'd like to wrap it up and thank everyone for their time and attention, and we look forward to seeing you again next quarter.